Imagine it's July 2019. A private jet touches down in New Jersey. Federal agents are waiting on the tarmac. Jeffrey Epstein, financier, socialite, and a man connected to some of the world's most powerful people, is placed in handcuffs. For many watching the news, it looked like a sudden fall, a powerful man finally caught. But the truth is more unsettling. Epstein's rise and collapse were not sudden at all. They were the final chapter of a financial story that had been unfolding quietly for decades. Behind the headlines was something far more complex than a scandal. It was a financial network built on relationships, secrecy, and institutions willing to look the other way. This is not a tabloid story. It's a financial autopsy. How one man built a fortune that few could explain, and how that system kept operating for years. Epstein did not come from extreme wealth. He started as a math teacher at the Dalton School in New York, a prestigious institution where the children of wealthy families were educated. That job changed his life. It placed him in rooms with people who controlled massive fortunes. By the late 1970s, he had left teaching and entered the world of finance at Bear Stearns. It was one of the most aggressive investment banks on Wall Street at the time. Epstein worked in the options division, a fast-moving corner of the market where fortunes could be made quickly. Within a few years, he had built a reputation as someone who understood complex trades and wealthy clients. But his time at Bear Stearns was short. By the early 1980s, he had left the firm. The details of his departure remain unclear, but what came next would define his financial life. After leaving the bank, Epstein positioned himself as a private financial advisor to extremely wealthy individuals. He presented himself as someone who could manage complex fortunes, handle tax strategies, and navigate elite financial circles. His firm, J. Epstein & Co., claimed to serve only billionaires. One of the most important relationships in his life began in the early 1990s. Retail billionaire Les Wexner, the founder of L Brands, became one of Epstein's closest clients. At one point, Epstein was given sweeping authority over parts of Wexner's finances, including control over major assets. This relationship transformed Epstein's life. He gained access to luxury properties, private jets, and the social circles of the ultra-wealthy. To outsiders, it appeared as though he had become a billionaire almost overnight, yet very little was publicly known about how his money was actually earned. At the same time, questions about his financial past lingered. In the late 1980s, Epstein had worked with financier Stephen Hoffenberg at a company called Towers Financial. The firm later collapsed and was exposed as a massive fraud. Hoffenberg was convicted and served a long prison sentence. Epstein was never charged, but the episode remained a shadow over his early career. By the late 1990s and early 2000s, Epstein had constructed an international financial web. His operations stretched across New York, Florida, the U.S. Virgin Islands, and offshore jurisdictions. Much of his wealth was held through private companies, trusts, and shell entities, making it difficult to trace. The U.S. Virgin Islands became a key part of this structure. By establishing residence there, Epstein gained access to significant tax incentives designed to attract wealthy investors. These programs allowed qualifying residents to dramatically reduce their tax rates. Over time, hundreds of millions of dollars flowed through entities based in the islands. At the center of this system were major global banks. For years, large financial institutions handled Epstein's accounts and processed transactions connected to his network. Internal reports at some banks flagged unusual activity. These were known as Suspicious Activity Reports, or SARs, which are routine alerts used to monitor potential financial crimes. Despite these warnings, the banking relationships continued. Over time, billions of dollars moved through accounts connected to Epstein and his associates. The exact nature of his advisory work remained opaque, but the fees he collected from wealthy clients were enormous. One example involved billionaire investor Leon Black, who paid Epstein large sums for tax and estate planning advice over several years. The payments raised eyebrows because they appeared unusually high compared to standard advisory fees. Yet they continued even after Epstein's earlier legal troubles had become public. After one major bank cut ties with Epstein, another international bank took him on as a client. The relationship lasted for years and generated millions of dollars in fees. Again, internal compliance concerns were raised, but the accounts stayed open. This pattern repeated across his network. Wealth flowed in through client relationships, moved through private entities, and settled in offshore structures. There were no public shareholder reports, no transparent filings, and few outside audits. To the outside world, his fortune looked like a black box. And that black box kept growing. By the time of his 2019 arrest, court filings suggested that Epstein controlled hundreds of millions of dollars in assets spread across trusts, companies, and properties around the world. But the structure that had protected his wealth for decades began to unravel quickly. Banks faced lawsuits for their relationships with him. Some agreed to large settlements. Financial institutions were forced to explain why warning signs had not led to earlier action. At the same time, Epstein's estate became the center of legal battles. Claims from victims, lawsuits from governments, and disputes over assets all converged on what remained of his fortune. The empire that once seemed untouchable began to shrink under legal pressure. In the end, the story was not just about one man. It was about a system that allowed wealth, secrecy, and influence to operate with limited oversight. It showed how elite financial networks can become insulated from scrutiny, especially when powerful clients and large fees are involved. Epstein's rise followed a simple formula: build relationships with the ultra-rich, position yourself as indispensable, and move money through structures few people could see. For years, that formula worked. But when the spotlight finally turned on his finances, the structure proved fragile. Lawsuits, investigations, and public pressure exposed the cracks. What once looked like a billion-dollar empire turned into a legal battlefield over what remained. The real lesson isn't just about Epstein. It's about how financial systems respond to powerful clients. Banks, advisors, and institutions are supposed to act as gatekeepers, but when enough money is involved, those safeguards can weaken. And that raises a question that goes far beyond one scandal. If a financial network like this could operate for decades around one man, how many others are still hidden behind the walls of private wealth? Because history shows something uncomfortable. Financial scandals rarely end with a single name. They usually reveal an entire system that made them possible.